Good morning. My name is Erica Toms, and I am Government Relations Liaison for the Federal Reserve Bank of Cleveland. Thank you for joining us for this webinar on state and local government budgets in the face of COVID-19. I would like to introduce our panelists. Stephan Whitaker is a policy economist in the research department at the Federal Reserve Bank of Cleveland. His current work includes research on housing markets and studies of state and local public finance. He holds a BA in economics from Columbia University and an MS in statistics from Colorado State University. Before earning his PhD in public policy from the Harris School at the University of Chicago, he served as a lieutenant in the U.S. Air Force. Hiteshew has more than 35 years' experience in public finance solutions to both state and local government debt issuers, federal policymakers. Currently, he is a deputy associate director in the Office of Financial Stability at the Federal Reserve Board. He joined the Federal Reserve in March 2020 to bolster the Fed's municipal market expertise in response to market disruptions resulting from the COVID-19 pandemic. He has been responsible for developing the Fed's crisis response, including the Municipal Liquidity Facility. From 2014 to 2017, Hint served as the first director of the Office of State and Local Finance at the U.S. Department of Treasury. Hint is a graduate of Rutgers and holds a master's in city planning from the University of North Carolina, Chapel Hill. After we've heard from our speakers, we will move into Q&A. Stephan, please begin.
I'll start off by reminding everyone that the views I express in this presentation are mine alone and do not necessarily represent the Federal Reserve Bank of Cleveland, the Board of Governors, or the Federal Reserve System. So I thank you all for tuning in this morning to hear about the data brief that I've published on the 29th of June. This is a project that started back when we were all first going home at the end of March. We knew that the shutdowns put in place to address the pandemic were preventing a lot of the economic activity that serves as the tax base for state and local governments. And so we wanted to get some sense of how dire this situation would be, how negatively the public sector would be impacted. And at that time, official statistics on employment and consumption under the shutdowns was not yet available. So we started using some high-frequency data that we had in hand, and then I've been able to update it over the months that have passed since, as we get official statistics on consumption and employment and other measures. The estimates I'll present here are arrived at using a method that's quite different than most of the other estimates that are in circulation. Most other researchers have approached it using some sort of projections of unemployment rates or GDP, and then a past relationship between those rates, those measures, and state and local government, state and local revenues. What I did instead was I started off with the line items in the 2017 Census of Governments. This was in part because we're responsible for monitoring conditions in our district, and I needed to be able to say something about specific counties, cities that fall in our district. And the Census of Governments is the most recent data that covers all 85,000 local governments in the U.S. And they take the financial statements and categorize all their sources of revenue into 58 different types. I raised those fiscal year 17 values up to a baseline for fiscal year 2020 and fiscal year 2021 using the growth in state general fund revenue that's reported by the National Association of State Budget Officers in their fiscal survey. After I'd done that, I paired each of those 58 types of revenue with the best measure I could find of how much lower the tax-based economic activity is during complete shutdowns relative to what we would consider normal conditions. So in the current version, I use employment data from the current employment situation, and that's interacted with the occupational earnings survey to estimate income tax losses. And then I use the national income and product accounts, personal consumption expenditures, monthly data, and contrast April and May with January and February to represent how much of a decline there is as the stay-at-home orders and other restrictions are put in place. For other sources of state and local revenues, such as severance taxes, oil prices are a good proxy. And in the data brief, I list all of the pairings. So after I had that estimate of how much lower the activity is under the lockdowns, I proposed 3 scenarios that speak to how quickly the lockdowns are reversed. So there was a V shape that assumes that there's a quarter of full lockdown followed by a 50% reversal or sort of return to normal, and then we're back fully to normal 1 quarter after that. The slow scenario assumes that it'll take 4 quarters to rise up from the lockdown level of activity back to normal. And the third and most severe scenario is a second wave, where I assume that the shutdowns are partially reversed, or 50% reversed in what would be the 3rd quarter of 2020, but then in the 4th quarter of 2020, they're all reimposed for another full quarter, and then a slow recovery follows that. So using these scenarios and the end of fiscal year, which is identified in the Census of Government, I could map the declines in revenue, the percentage declines in economic activity into the fiscal years of the state and local governments. And so that mapping gives me an annual decline in the economic activity that serves as a tax base. And then I can multiply that annual decline times the baseline revenue, the dollar value. And that gives me a dollar value of revenue lost for every individual government and each type of revenue. So with that microdata, I could then aggregate it to any level that we might be interested in seeing. So I'm going to show you some tables from the data brief. So you can find these there. Some of them I slightly rearranged to emphasize things, but this is table 1 that has sort of the grand total aggregation for states and local governments. So my technique estimated that state governments lost $85 billion in fiscal year 20, and local governments lost or will be losing, because some of them have not ended their fiscal year 20 yet, $56 billion. The state governments, since that most of them closed their fiscal year on the 30th of June, we are starting to get reports of what the actual revenue was, and we'll be able to confirm that soon. Unfortunately, for local governments, it's going to be a long time until we know how severe their situation actually is, because that data is not aggregated and reported quickly. Some cities and counties might be able to put a number out there, but there's 85,000 of them. So even to get a survey of that, there's often up to a year or more of a lag. Turning to the scenarios, in the slow scenario, I'm estimating that in fiscal year 21, states will lose $122 billion and local governments will have revenue losses of around $49 billion. If we move to the second wave scenario, the more severe scenario, both of those loss estimates either almost double or a little bit more than double, to $238 billion for states and $112 billion for local governments. Okay, so the first thing that we need to do after we have these estimates is remember that states and local governments, while they cannot borrow in general to cover these types of revenue losses. They're operating under balanced budget requirements, which are either in state constitutions or sometimes they're statutory, but they're generally not relaxed even during the most severe recessions, like during the Great Recession. So these revenue losses have to be countered with either cuts in expenditures or increases in other types of revenue that can compensate for them. While state and local governments aren't allowed to borrow for current operations, they certainly do borrow for investing in infrastructure. They are allowed to save, and they do save. So they have specific rainy day funds, and then they'll also have unassigned general fund balances that they carry from one fiscal year to another. Fortunately for the states, the National Association of State Budget Officers surveys and reports those values, those sort of fiscal stabilization funds. And so I could subtract off that set aside from what I was estimating as the state lost revenue. And if I assume that they're going to split those between fiscal year 20 and 21 because they're looking forward and knowing 21 is going to also be an additional year, that brings down the estimated cuts that they might have to make to $40 billion in fiscal year 20 and 69 or 183 billion in fiscal year 21. Now, there isn't an equivalent good source of data on the reserves carried by local governments, but we know that they certainly do carry them. We've done a small survey here in our district, and on average, cities were carrying about 30% of their expenditures in unassigned general fund balances, and counties were carrying about 35%. There's a very wide range, of course. Some places have only 3%, others as much as 98%, but the funds exist. And so that's something we should keep in mind as we're considering if state and local governments need help, the amount they need could be lower by what they are already have set aside exactly for a situation like this. All right, so here's a couple other aggregations I'll run through quickly. This is it in the table in the data brief. Sales taxes was the hardest hit, according to my estimation technique, losing $40 billion in fiscal year 20, and this is a combined state and local. Individual income taxes, well, we thought this would be a substantial area of loss. States do rely heavily on it, but I was estimated that only about $12 billion of losses accrued there. Now, one thing that my technique does that I think is important is some of the other estimates that are circulated focus on general funds and are based on that data. In the census of governments, all funds for public entities are reported. So you have things like public hospitals, and there's a lot of revenue passing through there, and they, like nonprofit and other hospitals, sharply cut back on any elective surgeries, or even, just had fewer people coming to the hospital because they were concerned about contracting COVID. So there was a major decline in government hospital revenue, and that ends up being, in my estimate, the second greatest loss. And then some other airports are in a similar situation. Toll roads also are facing substantial decreased revenue. Advance the slide here. Okay. Now, this is a subset of the table 2 that's in the data brief. Here, I've just sorted it by which is the highest, which are the highest states in terms of their own revenue that they may be losing due to the pandemic mitigations. North Dakota and Alaska end up being high, and the largest losses for them are in severance taxes. And then most of the rest of the states that are facing large losses are those that rely pretty heavily on sales taxes. And so that's the case for everything from Nevada down to Hawaii. And we see here that other than the highest values, around 15%, most states are looking at losses of own revenue, 10%, and then down from there. Okay. What about the local governments? In the data brief, I averaged the local governments' potential losses of own revenue, averaged it within their state, and reported that. Here I've ranked the states by the lost revenue. And this again highlights the importance of the special districts. So if we look into Nevada's the microdata, where are the losses happening in Nevada? Actually, air transportation is the biggest factor. And then for Wyoming, North Carolina, California, West Virginia, and South Carolina, it's all the hospital revenue is the largest area of potential losses. Now you'll see that the averages here all stay below 10%. This just reflects that local governments rely more heavily on property taxes. And I've assumed, looking back at experience in the last couple recessions, property taxes generally don't decline until a couple years after the trough of the recession. And that's because there's a long lag built in with the appraisal process. And mortgage services will continue to pay property taxes even if people are delinquent on their mortgages, because the servicer has to maintain the first lien against the property and not be superseded by a tax lien. So that is protective of local governments and their revenue. So a couple questions have come my way after I put this data brief out there. And so today I'm presenting one more table that was not in the data brief, but tries to speak to some of those. So one question I received was, what does it look like if you consider that the state governments are going to have to pass on their revenue losses by cutting their intergovernmental transfers to their local governments? And then the other question was, I'm reporting means of the local government losses, but there's a distribution. There's going to be some places that are facing almost no loss and others where it's catastrophic. And, I'm reporting a mean of 5 or 6. So here what I've done is I took the state's revenue losses, assumed that they would proportionally pass them on to their local governments through any intergovernmental transfers that they do. And then I added that to the estimated revenue loss for the local government itself, its own revenue, and then categorized the local governments by whether they were facing a 5% or less cut, 5 to 10%, or greater than 10%. Now, I don't think it's too interesting. I could report the numbers that fell in each of these categories, but some of these places could be very small and that sort of misrepresent the problem. So I translated it instead into populations. And so we could read this as 54 million people are living in a city or town that is facing a 5 to 10% cut, or needs to make a 5 or 10 to 10% cut in its expenditures. Only 3 million people are living in a city or town that's facing over a 10% cut, which we consider, that could be very dramatic and endanger life and property by having to cut back severely on essential services. Counties, the situation's similar. We got about 22% who are facing a probably quite painful 5 to 10% cut, but just 2% that are above that 10% cut threshold. School districts, I was kind of surprised by this. We were concerned that if their state revenue was cut, that a lot of schools would have to make very dramatic cuts. As I've calculated it, we've only got about 15% that are facing a 5 to 10% cut, but that's a cut from baseline and doesn't take into consideration what the schools are going to have to spend right now to accommodate social distancing. And lastly, the special districts, which I've mentioned a few times already, they don't have populations often. If you think about an airport, it's serving hundreds of thousands of people, but it doesn't have residents. So what I've reported here is the expenditure, the aggregate expenditure for the special districts by the cuts that they're facing. And we've got 22% facing 5 to 10% cut and a 10% facing over a 10% cut. So 38% of the special districts by expenditure are looking at some substantial cutback that they're going to have to accommodate, possibly through layoffs or other cutbacks. And they don't necessarily have the options that even a local government has to raise additional revenue by increasing tax rates. So I'm going to conclude here and just leave you with 3 takeaways as you consider what kind of aid local governments would need. Keep in mind that they do have savings, that there's a distribution, that some are going to be facing much more severe cuts than others. So we might want to think about how to target those that are in most need. And also keep in mind the special districts, because according to my estimates, they may be facing the most severe circumstances in the year ahead. Thank you.
Thank you, Stephan, so much. We'll now turn to Kent's presentation. Kent.
Thank you, Erica, and thank you, Stephan. That was a really terrific look at the fiscal situation facing state and local governments, and a daunting one at that. I'm going to switch gears and pivot to the municipal bond market. As most of you know, or many of you know, for the first time in its 100-year history, the Federal Reserve Board used its statutory powers to intervene in our nation's municipal bond market. So today what I'd like to do is talk about 3 things. What were the conditions in the municipal bond market in March that necessitated this historic intervention by the Fed? Secondly, what were the components of the response by the Fed and Congress? And third, what are the current conditions in the municipal bond market? And what access to capital do state and local governments have as a result? So let's talk about the muni bond market for a bit. For those of you who are not familiar with it, it's a long-standing $3.9 trillion capital market that's essential and critical to state and local governments for raising funds for capital infrastructure investments. 75% of our country's infrastructure is financed by state and local governments. But it's also used to manage cash flows and liquidity as well. Stephan has already made some estimates of the size of the state and local sector. In the muni bond market, we estimate that there are over 50,000 issuers in that marketplace. In the corporate bond market, for example, there are only about 6,000. And these range from very large states and special districts and cities or major cities that issue frequently, have billions of dollars of debt outstanding, to tiny towns, villages, school districts, and special districts that come to market infrequently and have less than $100 million, less than $50 million of total debt outstanding. This debt is comprised of over 1 million separate securities. We call them CUSIPs. And each of these securities has its own maturity date, its own redemption provision, its own interest coupon, and its own credit. There is about $400 billion of municipal bonds newly issued into the market annually, but some years more than half of that is for refinancing purposes, which is currently the top purpose for issuance in the market today. The municipal market, I think as all of us know, the unique aspect of it is the securities interest is exempt from federal and in many cases state and local income taxes, and therefore it provides a lower cost of funding to state and local governments than if they were to borrow in the taxable markets like corporations. As a result of this tax-exempt feature, however, approximately 70% of the investor base for municipal bonds is comprised of individual retail investors who purchase municipal bonds for their tax advantages, for savings, for colleges, retirement, etc. About half of those retail investors actually invest through institutional conduits, such as mutual funds, investment advisors, and what are called separately managed accounts. The balance of the market is made up of commercial banks, property and casualty and life insurance companies, and other institutions. Essentially, you're not going to invest in the municipal bond market if you don't have the advantage of getting the exemption on your income taxes, which corporations do not, and pension funds notably do not. So they're not a factor in our market. Just as an example, the corporate market probably only has about 20 to 25% of its market comprised of retail investors, much, much less than the municipal market. So in March, we had an unprecedented market disruption, a sell-off of historic magnitude. It was triggered by the COVID pandemic and the resulting sharp equity market losses and drops, the volatility in the market, including volatility in the treasury market. How did this translate or manifest itself in the municipal market? Mutual funds, who are the conduits, as I explained, for retail investors, lost $45 billion of assets from their retail investors in just 2 to 3 weeks. This is a historic outflow of funds that would otherwise invest in municipal bonds. It's 3 times the worst month ever experienced in the history of the municipal market. That's only happened several times past. As a result, interest rates spiked as prices plummeted lower and lower. We had short-term variable rate interest going as high as 9 and even 10% at the worst moment in March, as U.S. Treasuries, pursuant to the Fed's monetary policy, were heading to zero. This caused forced selling of bonds into a market in which there was very little bid. And finally, importantly for issuers, the new issue bond market essentially closed. Very, very few transactions could get done, even for AA and AAA issuers. All this happened in just 2 or 3 weeks. So the scale and the speed with which this disruption occurred, as I mentioned, was historic. It was a classic liquidity-triggered crisis. It was not like the Great Recession in 2008 and 2009, a credit crisis that occurred in other markets, at least initially. Obviously now, as the economy has worsened and the unknown recovery faces us, there are clearly going to be credit implications into the municipal bond market. But at least initially, it was a liquidity-triggered crisis. The Fed's response was comprehensive and rapid across most of the capital market, including munis. Of course, the Fed's statutory authority is to, in emergency situations, to provide stability, liquidity, and return the markets to normal functioning. The first thing, of course, the Fed did was adopt a zero interest rate policy and to deploy massive purchases of U.S. Treasuries and mortgage-backed securities to stabilize all the markets. And that certainly was the baseline for helping the municipal bond market to recover. Second, more of a technical move that the Fed made that is not as fully understood or appreciated is that one of its facilities that had already been open to assist money market funds was widened and expanded the eligibility of securities on March 23rd to include municipal bonds that are variable rate in nature. And so these were now allowed to be purchased by that facility. That had a dramatic immediate effect on the municipal market by stabilizing the upward move in variable rate pricing. And it began a march downward to today. Those levels are about 10 or 20 basis points after having approached 9% on March 21st. Of course, on March 27th, another very important event occurred. Not the Fed, but Congress passed the CARES Act. This was an important, not only for the benefits that it provided U.S. citizens and state and local governments and companies, but it also contributed to the stabilization of the municipal bond market because of the $150 billion that was appropriated for state and local government aid, and because of the $500 billion that was appropriated to the Treasury for investment with the Fed in these various facilities, and the signaling that it gave to the marketplace, including the muni market, that the Fed and Congress were acting. And then finally, on April 9th, what is the title of my presentation, we rolled out the Municipal Liquidity Facility, a $500 billion facility that was rolled out at the same time as other facilities totaling $2.3 trillion. So the mere magnitude of all these facilities together had a very positive impact on the muni market, all the markets, I should say, but especially the muni market, even before the details of the program could be worked out and the program could be operational. What were the objectives of the Fed in the policy objectives in developing and announcing the Municipal Liquidity Facility? They were really twofold. The first was to make sure that state and local governments had access to sufficient liquidity to manage their cash flow and liquidity challenges through this crisis. Of course, we've had delayed income tax revenues that just arrived yesterday after a 90-day delay. States and local governments are facing higher expenses, and as Stephan detailed, falling and uncertain tax revenues. The second, and the corollary to that, is that by assuring market participants that state and local governments had access to liquidity, that was a very strong signal to the marketplace about the creditworthiness of the muni issuers, and that was designed to help stabilize the overall muni market, in addition to providing liquidity to state and local governments. It was a powerful signal of Fed support for the first time ever in the municipal market. So what is MLF? Let me just give you the very basics of the program. The important thing to understand about the MLF is it was designed with 50,000 different issuers to try to take advantage of the existing municipal market infrastructure. That is, the legal authority is whatever the legal authority that states and local governments have to borrow. The credit ratings that they have are a critical element of the program. And then the issuance process, from authorization by town councils and state legislatures, as they normally do for the issuance of debt, bond councils, financial advisors, all the mechanisms that are tried and true in the municipal marketplace in terms of the issuance of securities are the same as they are for the Municipal Liquidity Facility. We're not changing that basic infrastructure. Importantly also, the Fed is not making individual borrower decisions. We're not underwriting individual credits. We're laying out what the criteria are. If the issuer can qualify, they have a set-aside amount within that $500 billion that they can borrow from. So there's nothing like the PPP where there's a rush to the doors to try to get in on the program. Borrowers can come in as they need the facility. Again, it's a $500 billion facility. We had to decide how to get this facility up and operating quickly, and how to manage a facility in a marketplace with 50,000 separate issuers. We've selected 400 issuers that are eligible, all the states and large cities and counties, and 100 revenue bond issuers. The maximum size of a borrowing is up to 20% of annual revenues. Put that in the context of what Stephan was just mentioning. The eligible uses are obviously what the program is stated for and named. It's for cash flow management purposes, but it's broadly available. However you define your liquidity and cash flow, there's very little limitation on the use of proceeds. And importantly, we've encouraged, because of the decentralized nature of the municipal market, that states and even cities and counties use the program, if possible, to downstream support to their subdivision, their political subdivisions and instrumentalities and other governmental entities. So that's an eligible use. The sixth point was that the last criteria is that issuers have to have a credit rating of at least investment grade, or BBB minus, as of April 9th. So the program would even accommodate issuers that were if they were downgraded after the announcement of the program. Finally, my third point, what has happened since April 9th? What is the current state of the muni bond market? Well, much to the relief, I think, of state and local issuers and participants in the municipal market, and certainly the Fed and policymakers, we've had a very sharp and rapid and steady recovery of the municipal bond market since this historic sell-off in March. What do we mean by that? How do we define that? There's a blog on the New York Fed's Liberty Street Economics website that perhaps Erica can circulate afterwards, or you can you can go directly to that and look for it. It discusses, I think it's a June 29th blog, and it goes through in great detail, I don't have time to do today, what the municipal market did between March and June, and puts it in a historical context. So most importantly, we have normal two-way trading that's been restored. The short-term index for daily, weekly, monthly securities, as I mentioned, was approaching 9%. It is now in the 10 to 20 basis points range, 0.10 to 0.20. Interest rates for longer-term fixed rate, the index for AAAs is 0.75. For 30 years, you can borrow, if you're AAA, at 1.50. Lesser credits, of course, have a spread to that, but even the typical AA or single A credit can borrow certainly well under 3% for 30 years in the current market, and in some cases below 2%. The outflows that we talked about from mutual funds have reversed, and we're now seeing $1 billion a week of new investors coming into the mutual funds. That hasn't completely reversed the losses of March, but we're well on our way to doing that. Most importantly, to many in this audience, state and local issuers generally have broad access to the market. All but the least creditworthy, the lowest credits, have easy access at, as I said, historically low interest rates. We've set a record of issuance in the month of June, and after virtually no issuance in March and some of early April, this year, the first half of the year, again, is a record year of issuance with almost $200 billion of issuance. On the other hand, the Municipal Liquidity Facility, MLF, has had so far only one borrower. The state of Illinois borrowed $1.2 billion for a one-year tax and revenue anticipation note facility, and they're a BBB minus credit that many of you know. But notwithstanding only having one borrower, the point of the program is that it's a backstop. It's helped support the marketplace, and it's not going away. So the program at this point is in place through the end of the year. And of course, the Fed and the Treasury have the flexibility to extend the program, again, if municipal market conditions were to warrant. In the meantime, we remain vigilant at the Fed, monitoring the municipal market and access to the municipal market by issuers. No one is assuming that we're completely out of the woods here. We're vigilant in terms of potential reversals in the market that could be triggered by a second wave of the COVID, a shutting down of the economy, a stock market sell-off and volatility like we saw in March, and also even now potentially credit events in the municipal market as a result of the revenue losses that state and local governments could be facing. So I will close with that the Fed remains vigilant. We have broad authorities to intervene in the marketplace. The MLF has been the authority, along with the earlier variable rate facility I mentioned, that we've used to date, but we continue to be evaluating the market, and the board is prepared to consider whatever is necessary to address any future disruptions in the marketplace. So with that, I'm going to wrap up and turn it over to our host. And Erica, you may have questions for the audience, but I think we also have some issues that perhaps Stephan and I can bounce back and forth a bit.
Yeah, absolutely. Thank you so much, Kent. So we have a couple questions that came ahead today. First off, what is the appropriate balance and role of monetary versus fiscal policy in the current crisis? What can the Fed do to help states and locals address their revenue losses?
Well, I'll take a first stab at that. So monetary policy is going to work in sort of indirect ways by generally stimulating investment and consumption, which translates into employment and then income tax revenue for state and local governments. The consumption could translate into sales tax revenue. Other than that, by keeping interest rates generally low, that's going to give some local governments an opportunity to refinance and save a little bit on their interest costs. Those will be minor savings. They're probably not going to be on a scale that could address a loss of 5% or 10% of your revenue. So the issue is that because local governments are operating under balanced budget requirements for their current operations, even if we were to be able to do something in the capital markets that either offered to lend directly for, say, smoothing out a cut of operations. So we're gonna borrow some money this year, keep our operations at a higher level, and then repay it over future years. Even if we could either make that available directly or incentivize it by private lenders, most state and local governments are going to be unable to take advantage of that type of borrowing because of their own balanced budget requirements. So fiscal policy has more flexibility. Even in good years, good and bad years throughout the business cycle, there are always flows of federal funds going to states and from states to local governments. So the Congress can decide if they want to make something available that's a type of loan or grants like we are seeing in the CARES Act. So those had very specific prescriptions of what they could be used for. But if they are used for those purposes, then they are a grant to the state and local government. So in general, I'd say that fiscal policy has more flexibility in addressing these specific revenue losses that are could possibly translate into cuts in current operations.
I think that's a terrific answer. I'll just add a little bit from the perspective of our chair has testified on a number of occasions that it's going to take both monetary policy and fiscal policy to get us through this crisis, that monetary policy cannot alone solve all the problems. And I think specifically when we're talking about lost revenues, that is not typically what state and local governments would do even if they had the legal authority to do. Some do, and there will be some of that. It varies. I like to say the municipal market is 50 separate markets, with each state's constitution determines what the legal structure is of both state and local government securities. So I think that the Fed's job in terms of monetary policy is to make sure that the municipal markets are functioning, and that to the extent that state and local governments decide to use debt for some amount of smoothing for liquidity purposes, that they have access to the capital markets to do so at the lowest possible interest rates. But in general, as I said, 75% of the nation's infrastructure is financed and built by state and local governments, they depend on the ability to have to use a certain percentage of its budgeted revenues to pay debt service for that purpose, to the extent that they have to use future debt service to pay for one-time operating revenue losses that will constrain their ability in the future after this recovery to continue to be an important source of funding our nation's infrastructure.
Great, thank you for that. We have a question that came into the chat function, actually quite a few. Let me start here. How would you recommend that state policymakers design a relending program to serve smaller municipalities ineligible for direct participation?
Yeah, great question. Well, again, I indicated that the MLF is built on and utilizes the existing infrastructure in the municipal market. And there are quite a few examples around the country of states that have developed bond banks to borrow on behalf of local governments and then to turn around and relend that money to local governments. And they use a variety of credit supports to homogenize all those credits into a better credit than they would be if they borrow it on their own, and they also get the efficiency and the economies of scale. So that would be one example of a number of states have developed that. That can't be done without state authorizing legislation. And one of the reasons why the MLF program has a longer shelf life by 3 months than the other facilities, which expire September 30th, was the board's recognition that not only do revenues lag, as Stephan mentioned earlier, but that any kind of bond issuance typically requires legislative authority at either the local level or the state level. So the downstreaming is not going to be legally possible in every state, but to the maximum extent possible, we're looking to try to use the states as a vehicle to make sure that local governments have access. And of course, to the extent that the biggest issuers' needs can be satisfied, we're seeing increased activities by regional and commercial banks providing such facilities to smaller issuers.
Great, thank you. Question, Brookings Institute put out a report early in the crisis that said that Ohio's local governments were particularly vulnerable because of the reliance in Ohio on local income taxes. Given that the Fed data is showing that Ohio local governments face less of a loss than other local governments, is that a feature of other local governments around the country being dependent on even more volatile revenue services? Or are you seeing that local government income taxes are holding up better than expected? You know, I know we don't talk much about how state and localities should raise money, but do you have thoughts on this, Stephan?
Well, so sales and income taxes are the most volatile streams that local governments rely on heavily. And income taxes can be even more volatile than sales taxes. So I think the reason that my estimates came out looking a little bit less severe for Ohio was it was one of the things that you mentioned, just that we weren't seeing revenues decline by quite as much as we might have thought. And there's a few different reasons for that. Probably the main one is that my estimates are driven by declines in employment in specific industries that are then translated through occupations. And the occupations that got particularly hard hit by the shutdowns were often in services, retail, food service, hospitality, and it's just lower income levels. So they're contributing a smaller percentage of the state or the local income tax revenue. And so that led to an estimate being maybe less severe than if the job losses or income losses were uniform across the distribution.
Okay. Another question. 2/3 of the muni debt market are revenue bonds, and a significant portion of these revenue bonds are conduit debt for private activity. For example, Cuyahoga County recently realized how they were on the hook to cover losses for a convention hotel. Does the Fed Liquidity Facility cover conduit debt? And is the Fed tracking that percent? What percent of the bonds bought through the facility is general obligation versus revenue?
So the Municipal Liquidity Facility is available to both GO and revenue bond issuers. There are many state and local governments that have revenue credits that they can present as eligible for the MLF. To the extent that the revenue bond issuer is a distinct entity, like perhaps the Cuyahoga County example, revenue bond issuers, each state governor can select at their discretion up to 2 revenue bond issuers to make eligible for the MLF. The sector that probably is struggling the most in the municipal market right now, not surprisingly, is the convention center and the hotel economic development type projects that are dependent on highly sensitive or single revenue streams like hotels, which are obviously suffering significantly in the current climate. So again, we're relying on the existing municipal infrastructure system to deal with a lot of these programs. So between the city, the county, and the state, we would look for them to come to us with proposals in terms of how they might be able to fit within the Municipal Liquidity Facility to deal with that issue. But I don't want to mislead the questioner that that's an easy solution. Those are very challenging credits right now.
Okay. Stephan, we have a question for you. Did you back test this approach of estimating lost revenues? Maybe using the Great Recession as a sense check in terms of comparing actual occurrence to projections?
I haven't done that, but like I said, there are a lot of other estimates out there now that use the Great Recession experience, and particularly the relationship that defined between unemployment and state and local revenues. They used that to create their estimate, and so I can compare my estimate to what they arrive at. And I'm in the same ballpark as a lot of those estimates. The other reason that I didn't back test it is because this situation, especially when we were first starting out, seemed so vastly different. So in past recessions, you have one sector or maybe multiple sectors that sort of got overheated, were doing something unsustainable, and then that activity stops, demand drops, and you get into a recessionary dynamic. But with this situation, we went from being at the peak of a cycle to having mandated shutdowns of all kinds of economic activity. So when I first approached it, I just didn't think that we really had a good historical precedent. And that's why I focused in on finding the best contrast I could between that normal activity and activity under shutdown. And that's what I really focused on.
Great. Another question here, and this may be our last one, depending on time. Stephan's FY20 loss estimate of $140 billion looks covered by CARES $150 billion.
No, sorry.
No? Okay. If a CARES 2.0 does not pass, would we expect state and local governments to dip into reserves and standard fiscal tools or more issuance through the Municipal Liquidity Facility? What concerns drive this decision?
Yeah. Okay. So we just have to get this out there that the CARES Act funding that went from the federal governments to state and local governments is highly, highly restricted. It's meant to cover costs that they hadn't budgeted for that are directly related to addressing the coronavirus and things like personal protective equipment or setting up facilities to treat infected people. So if you're just trying to make payroll in your police department and fire department, those funds cannot be used. Even if your revenue dropped, you can't replace it with CARES Act funding. So could you repeat the second half of the question? So it was if there was an additional stimulus.
If an additional stimulus doesn't pass, would we expect state and local governments to dip into reserves and standard fiscal tools, or more issuance through the MLF? And what concerns that decision, drive that decision?
Well, I mean, I think we should expect state and local governments to use the tools that they generally deal with in economic downturn. So whenever we get into one of these situations, there's debates about, well, are we bailing someone out? Are we setting up moral hazard, bad incentives so that people would make bad decisions in the future, get themselves in trouble? You know, I don't think anybody holds state or local governments responsible for the current situation or this loss of revenue. But on the other hand, in past recessions, they weren't necessarily responsible, but they set aside a rainy day fund to deal with these unexpected shocks that can come from anywhere. So I think it's appropriate that state and local governments would use at least some of their savings if they have it available to them. And if that's insufficient, you know, there will be a need that I've tried to make this point earlier, could be met through some kind of federal aid, but would be more difficult to meet through some type of borrowing due to the balanced budget requirements. If there's cash flow issues, of course, you know, the short-term borrowing within a fiscal year is used under all circumstances. It's used in normal years, good years at the peak of the business cycle, and it's critical that continue to remain available through the coming fiscal year. And that's the Fed's focus, is making sure that liquidity, that cash flow management borrowing is an option available to state and local governments going forward.
Great. I see we're at time, but I just wanted to check. Kent, did you have anything you wanted to add to that?
No, I thought that was terrific.
Great. Well, thank you everybody for attending today's webinar, for your questions. I hope you found it informative. Thank you, of course, to our speakers, Stephan and Kent, and please enjoy the rest of your day.